Hello, this is Mike Swanson. The odds are you're watching this video because you got an email from me telling you that it's up for you to watch. Now, I run the website WallStreetWindow.com, and every single morning, as part of it, I send out an email before the opening bell, Monday through Friday, with my market commentary, top links to the most important stories you need to know about. You can get it for free. Just scroll below this video, click the link to join it. Because we're in an interesting moment in the markets. I'm going to show you and talk about my public portfolio, what I'm doing in the markets. And we're going to take a look at the averages, the action today, what small traders or investors are doing, and how we'll be able to identify when the real bottom comes and perhaps where it'll come. I'm going to show you some possible bottom price points, something I've not done yet in my commentary or any of my videos. We got a lot to go through today. A lot of important stuff has happened. Bitcoin has gone below 30,000. There's malfunctions going on now in the crypto market. Shares of Coinbase are in collapse. The company actually put out an announcement that it's possible that they could go under, and if they do, if you got money in crypto with them, you ain't getting nothing back. Those accounts are not insured. They're not like regular brokerage accounts or bank accounts. The crypto market is turning into it's showing what it is. It's not a safe haven. It's good for speculation if you can time the price movements and trade it. That's great, but it's not a store of value. It's not anything worthwhile to invest in. But what about the stock market? Because it's been going down. It topped out. The S&P did in January, and it broke down last week below 4,100 on Friday, and it's now trading on a 52-week low. It's a rough year. As of the close yesterday, well, now it's down about 17%. What's going on? It's in a bear market. Markets go through cycles, bull markets, bear markets, transition phases in between. There's stages, and you can easily identify the stage your market is in by how it's trading relative to its 200-day moving average. When the market's in a bull market, it trades above it. When it's in a bear market, it trades below it, and those moving averages then act as resistance. That's been going on for well over a year almost with the ARK ETF and many stocks. In fact, by the end of the year, more stocks were going down than up, even though the S&P 500 made a new high going into New Year's. That's because some stocks that heavily weight the market were helping the averages go up, hiding the fact that more stocks were going down than up. That all changed in January. These leadership stocks blew up. Facebook blew up. Netflix blew up. And last month, Google had a bad time. Amazon also has broken down. The only remaining big cap leadership stocks in the technology group remain Tesla, Microsoft, and Apple, but even they are trading down. So it's a difficult market environment. Some things are still doing well. Commodities are still in a bull market. Energy stocks are near highs. The price of gas just made a new high in the United States yesterday. So there are ways to make money, and there's always a bull market somewhere. But I want to ask you a big question. And everyone's focused on what's the market going to do. We'll talk about that in a second. And people feed you picks all the time. How many people have been pumping crypto coins over the past couple of years? And that type of content drives the financial media. It's what people want to hear. But more important than that is this question that you must ask yourself now. And that is, what are you trying to do in these markets? What are you really trying to do? What's your goal? Is your goal to buy a coin or some stock and try to get rich quick? Well, that's an unrealistic goal. And it, it's like trying to buy a lottery ticket, trying to turn the stock market into a lottery for you. Doesn't really work. And yes, there's stories of a stock going up a whole lot or a coin going a whole lot, but then those stories, the odds of being lucky enough to be in that situation, isn't that great. And then those stories are used to make you think that's normal. Well, now the action in the market shows it's not. And I will say, yeah, last year I had a couple stocks that did really well. A couple stocks that I bought actually got bought out by other companies. And I got huge one-day premiums in those stocks. But there's no way I could predict that was going to happen. And I own and still own dozens and dozens of stocks. So the only way you can really get into a great situation where one stock is going to give you this giant payoff is to be invested in many stocks. It's all about risk management, risk control. That's a top thing we'll talk about in another video. Again, what is your goal? That's the key. And I'm just saying, to try to get rich quick, throwing all your money in a coin, a stock, or one single trade is very risky, and it rarely actually works. And I want to tell you that there's really two realistic goals to have. One is to just be a regular investor and be well diversified and just put money in an account, on a regular basis, with the expectation that in 20, 30, 40 years, you're going to have a big nest egg. And the key to that is diversification. Now, in the market we're in the years to come, diversification is going to require doing something differently than what's been going on since 1980. So most investment advisors will tell you, put half your money in stocks, half your money in bonds, you're diversified. Well, that diversification worked from 1980 to now because bonds would go up when the stock market went down. Now, that's not happening because we're in an environment now like the 1970s where bonds are going down and stocks are going down because we got real inflation. And because bonds go up when yields go down, and that's not going to happen because yields hit all-time lows in 2020 and therefore set themselves up in a way to go up for years to come. So diversification requires doing more than just stocks and bonds. I believe things such as commodities, gold now provide a role for diversification. And personally, I've got 14% of my money in my retirement account invested in gold ETFs because of this reason. Anyway, so many things to talk about. That's a whole other topic. A simple point I'm trying to make is, what is your goal? What is your goal? And that's one goal someone can have. Another goal, which is my goal, is to try to beat the market averages. You see, look at the stock market as a competition, just as professional money managers look at it. And if you do that, the goal should be to beat the market. So how do you beat the market? Well, you're not going to do it on wild gambles on a consistent basis. You're going to have a money management strategy and an understanding of how the market works. Because if you think, okay, I want to beat the market, that means you're going to put yourself in competition with every single hedge fund manager on the planet and money manager. And now you realize to yourself, this is a serious game that requires dedication and learning on how to do it. So I would recommend that if you want to take that objective, that if you have never done it before, you start to read some books about how the markets work. Specifically, I would recommend starting with Stan Weinstein's book, Secrets to Profiting in Bull and Bear Markets. Again, Stan Weinstein, Secrets to Profiting in Bull and Bear Markets. Grab it, read it. It explains stage analysis. It also has a couple strategies in the book about how you could enter and trade stocks and even get out of them. It's not the strategy I necessarily use, but it's one I started with and one I think about. But you got to start somewhere. And this is the single best trading, investing, charting book I've ever read, my #1 recommendation. And if you're new to the market since 2020 and you're not willing to simply read one single book to get better at this after everything you're experiencing, I don't know what to say to you. I mean, I just don't. I'd recommend you just get out, liquidate your account, do something else. You're not serious about this. And that's the truth. So let me show you and you can beat the market. You can beat the market if you apply yourself. You can be a winner. It just takes taking it seriously. And my goal, an idea I had a couple weeks ago was I thought, okay, I do these videos. Maybe I could do these videos to show people how it's possible to beat the market averages and try to beat other experts and be a winner. So I set up a public model portfolio that pretty much mimics my retirement account to see. Let's look at my performance and the things I say. Do they make sense? Do they apply to the real world? Because so many people tell you things, it's easy to spit out stuff when it comes to the financial markets, and people love to hear picks. They love to hear trades, but do they work? Where's the track record for all these people? So I wanted to establish a track record and show you that we can put things together and navigate these markets along with each other by watching things unfold, talking about what's going on, and trying to figure out what's the best thing to do accordingly. So I'll show you my public portfolio. I'm going to look at the S&P. And here's the S&P 500. Again, it broke down today. The blue line's the 50-day moving average. The red line and the green line, it's hard to see it being green, but it is. It's around 4,500. That's the 150-day and 200-day moving average. And we're way below it. In fact, we're now below the lower 200-day Bollinger Band. That means you got to be very cautious. Buying now is catching a falling knife until there's signs of real bottom. I'll show you an indication I'm looking at to identify the real bottom, but I don't think it's here today. It's probably not here. It's probably going to be a while, unfortunately. But here's the portfolio I set up just a few weeks ago through TipRanks. I'll put a link to it below this video. So it's in a short ETF, PSQ, that's short the NASDAQ. It's in RWM, an ETF that shorts the Russell 2000. It's long gold. It's long DBA, which is the agriculture ETF. And the rest of it is parked for the time being in an ETF that's barely moves up and down at all. It's just a 3-month treasury bond ETF. I wanted to do that because I knew when I started this that the market, is very volatile, and I didn't want giant swings to happen in my account. So I have 50% long positions, 50% short positions to minimize the risk in what's an extremely volatile market. And volatility whipsaws. It's difficult to navigate. So I wanted to put myself in a position where I have the flexibility. If I wanted to, I could start buying stocks right now. I could sell those short ETFs, use that cash, sell SGOV, and then, put on some new positions in the market, because there is going to be an opportunity when this decline comes to an end. And I want to be ready in a position to be a buyer when it's over, not someone holding everything, watching, and too scared to do anything or unable to buy because I'm fully invested as things are falling. No, I want to be in a position to be a buyer when everyone is panicking and selling. That's one of my goals, to beat the market, and since I've set up this portfolio, the results, it's only been 2 weeks, so it doesn't necessarily mean a whole lot, but the average, I'm now ranked since in a 2 or 3 week period, number 74,913 out of 512,000 other people on tip ranks. I want to put myself in competition, all those people, and get ranked up, up, up. That's my goal. My goal is to be one of the winners, not just be someone sitting here like, oh, the market's going up or down. Oh, I hope it goes up. No, I want to beat the market and I want to beat these people. This is a game. I'm in it to win. If you follow me, I want that to be your goal too. I want you to become a winner in these markets, not someone just sitting in these coins dying financially. This is, get the book, get Stan Weinstein's Profiting in Bull and Bear Markets. Join me just by following my videos and my content, and let's see if we can be a winner this year, even with the market trading the way it is, because there is going to be incredible opportunities. So look, the average expert in the month of May, it's only been 11 days, is down 10.63%, while the S&P 500 is down 3%. That's just this month. My little portfolio that I started up 1.62%. No, that's not 100%, 1,000%, but I'm beating the market. I'm beating most of these experts, and that's my goal, because if you do that over time, you will generate mega wealth. That's my goal. You know, not this is a lottery ticket. I want sustainable investing strategies where when things do drop, I'm not scared, because, you know, you can navigate things. So here's how we're invested. Again, the percentages are now, you know, the PSQ is going up because the market's going down much more. It's a one-time short NASDAQ ETF, but we're now roughly 18% in that, 16% RWM, gold, IAU, DBA, 14.55%. This is the overall return. You know, I'm down on gold, down on DBA, but they're not as down as much as the market averages. So that's what's going on. And I don't plan on making any trades today, probably not this week, because I think I'm waiting for an opportunity where I really see something good to start buying more and getting out of these shorts. You know, at this point, I think it's too late to short the market. You got to short into rallies. In my retirement account, my main account, I shorted. The last time I shorted was in April, when the day the S&P fell through 4,400. I think around 4,350 or so is probably where I did it. So I'm just holding from there. You know, I had shorted going into the year with some shorts and got out in March. It's tough. I'm not recommending shorting. It's not easy to say the least. But the easiest, it's not easy holding, you know, when things are dropping. That's you know, that's how you lose money. So one of the ways I'm going to look for a bottom is I'm watching, look, bottoms in the market tend to come, well, take a look at what's going on. I just want to point this out to you. Coinbase is crashing. This stock is down over 50% in 3 days. It's a total debacle. It's the biggest publicly traded crypto wallet company out there, and it's crashing. This crypto coin market is malfunctioning. Well, I point this out because one of the things I'm tracking is this page right here. You can find it on Google by typing orders by Fidelity customers. Now, what it shows is the top things being traded among Fidelity customers. These are individual traders, and it shows you the ratio of buy to sell orders. So on today, when the S&P is making a new low, people are buying. They're not selling in panic. They're buying, trying to guess the bottom. Now, bottoms come when people panic and sell. And I believe, I'm pretty convinced, the day a bottom comes, there will be more sells among Fidelity customers than there are buys. The opposite is happening today. So the number one traded stock is Tesla, almost 2-to-1 on buys versus sells. Coinbase is number 2, despite the fact that Coinbase is crashing, it is down 30%. It's the second most traded stock here, and people are trying to guess the bottom. They're doing the same thing of Apple. and they're doing it with the QQQ triple ETF. They're buying more of that. Now, the SQQ, which is the short ETF, the NASDAQ, has more sells than buys. So, and they're trying to buy GameStop. People in AMC, by more than 10-to-1 margin, they're trying to buy GameStop, close to 20-to-1. So people, when you see names like GameStop and AMC, what you're seeing is that people in the markets that are active, the individual trader, they are trying to trade the stocks that were hot in January of 2021. They're acting as if the market is what it was 12 months ago instead of what it is today, and that is a bear market. And people are in the market, are not adapting. They're in denial of what's going on. They're unwilling to take the responsibility necessary for their own actions to raise some cash, or stop at least engaging in the same behavior that they were 15 months ago, really. That's no longer conducive to the cycle and the trend that this stock market is in. All these people, I guarantee, that are doing this on this screen are losers in the market. And I know videos like when it comes to YouTube, the financial media in general, what works is giving people what they want. That's what generates clicks, views, repeat customers. So YouTube is dominated by crypto people, bullish, making wild claims and predictions. It's dominated by Cathie Wood and people who mimic her, not by people like me saying, hey, this is going to go lower, be careful, sell. No one wants to hear that. So most people that go to this video, they will click off the video as soon as they hear what I'm saying. If they don't recognize me, watching this for the first time, and YouTube sees that and says, oh, people don't like these videos. So I'm punished by telling you these things, that I'm doing, as far as trying to grow an audience, grow hits. My hope is that I can't cater to the masses of people, but I can get a small number of people that are serious and are the winners in the market and be happy with that. Because look, I also think the flip side of what I'm just saying is that there's going to be a shakeout in the financial media. A company called MarketWise, they run a financial newsletters, and they reported earnings last week, and they said we had 1 million paid subscribers to our financial newsletters in January. Now we got 900,000. They lost 100,000 people. That's what happens in bear markets. So yeah, you can build a big audience, but when that audience shrinks or wipes out, which is happening with Robinhood, they lost 10% of their customers. Coinbase is losing customers. Then what do you have left? So for people like me and creators of financial content, or people that do it as a business, it's an interesting year where a lot of things, it's just an interesting time. So I think of it like the same way I think of my investing. I'm not here to try to get rich quick or a quick return. I've been doing this since the 1990s. So that's, it's not a flash in the pan here. So anyway, as I said, when the real bottom comes, and yeah, we can see the Dow up 1,000 tomorrow, and then fall. It did that last Wednesday. It could do it. I'm looking for the real bottom, not a temporary bottom. It'll come when there are more sell orders than buy orders on this screen, and not, people are selling instead of buying. That day will come. So when will it come? Well, one of the things about technical analysis is one of the techniques is to look for retracement levels of rallies to try to find support levels, and they typically do work. And here are the typical long-term support levels once you breach the 200-day moving average, which has already took place, and we're now decisively trading below it. So the S&P is at 3956. The first support level is roughly the 1/3 retracement level of the March 2020 low. and the peak of the S&P, that's at 38.23. That's 125, 20 some points away. Not that much farther away. You're talking, that's the 1/3 retracement level. I doubt that will hold as the final bottom, the way things are trading. We're just not seeing enough panic in the markets. I believe we could bounce off that level, but I'm very skeptical it's the bottom. I wrote a post earlier this week saying the way this really feels to me is similar to what happened in 2008 when the markets broke down that September. And I'm not saying real estate's crashing or going into financial crisis, just the action in averages, and they fell for almost 2 months. Or it's similar to the way gold broke down in 2012 in the fall, and it had a pretty sizable drop. That's how this looks to me. A slow trending down week by week market over the course of several months. And it's already been going on since January. So the next level that I think is a potential bottom is 35.11. There's just say 3,500. That's rough, the 50% retracement level, or the March bottom and the January high. Of course, that's a steeper drop for the NASDAQ, and things such as the ARK ETF will fall into oblivion. And crypto, look for it to go below 20,000, perhaps even down to 10 if that happens. I think it's a good chance we bottom there, but I don't base my decisions on trying to predict the future. I'm going to look for signs of a panic bottom, and I'm going to be a buyer when it comes. That's my plan. Maybe I won't be able to execute that plan. That's why I still have long positions, because I'm hedged. My plan is just to take off the hedges and then buy more. But I got a lot of long positions, and I keep those long positions, one, to save on taxes, but secondly, what if I'm wrong? What if I don't time it right? Well, if the S&P were to rally, up to the 50-day moving average, and I say all my analysis, what my thinking, has been wrong, I'd get out of the hedges and ride along. So, I have a backup plan in case I'm wrong, but I'm pretty confident about what I'm saying here. So I'm looking at 35.11 as a likely bottom for this decline. We'll see. It could be worse too. And the next level would be 3,200. That's a steep drop. I kind of doubt it'll go that far, but anything is possible in a market like this. If the selling really turns into a crescendo later, that's what could happen. Look, we're still in a stiff rate hiking cycle. So, I'm really talking with you about a decline that's going to last through the rest of this month into June or possibly even July at this point. So, this is the way it looks to me. Sure, I know Kathy Wood says otherwise, but she also said inflation would go away, and it hasn't. And that's where the strength is in the market. While tech is sagging, here's XLE, an ETF I do own in my retirement account. Near high. No sign of a bottom and top of any meaningful sense in commodities. We did get a pullback in the DBA ETF recently in the price of gold, as you saw in the public portfolio. I own this ETF and it's down. And I own this ETF in my IRA. I own this ETF in my main account. I have a lot of money in this ETF. But it's not trading like the S&P. Even though it's come down, it's not below the lower 200-day Bollinger Band. It's not making a 52-week low. It's a completely different setup. And I think it's going to benefit when the stock market stops dropping. In March of 2020, the price of gold fell 10% when the S&P fell over 33% and then soared. It went up faster than the S&P did. And I expect the same sort of thing happen. Gold is less volatile than the stock market. It is the true safe haven. And as one safe haven is being destroyed, the crypto market, some of these crypto people, a few, will say, hey, this isn't what I thought it was. Maybe I'll start investigating gold and silver. And they'll move into that, hopefully sooner than later. So anyway, thoughts. Those are my thoughts today on May the 11th. And if you like this content, please hit the like button. Then YouTube will know, hey, this is good information. There are people that do like it. And hit the subscribe button and then that bell next to it. And then YouTube will send you an alert as soon as the next video is up.